to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Central Bank of Sri Lanka has decided to keep its key policy interest rate unchanged at 7.75% following the latest Monetary Board review. The decision comes amid ongoing global uncertainties, particularly linked to geopolitical tensions in the Middle East. Governor Dr. Nandalal Veerasinghe stated that the country has built sufficient buffers to absorb external shocks. He noted that both inflation and foreign reserve buffers remain at comfortable levels, with reserves reaching around $7.3 billion. According to the central bank, the move reflects a careful assessment of both domestic and global developments, including potential risks to inflation and external stability. The governor said the inflation target remains at 5%. Headline inflation stood at 1.6% in February and is expected to remain around 2% in the near term. He further indicated that earlier projections suggested inflation could reach the target by third quarter of 2026. However, due to rising energy prices and global uncertainty, this timeline may now shift slightly, with inflation expected to stabilize by the second quarter. The central bank also highlighted that the deflation experienced over the past several months has created additional space to absorb short-term supply-side shocks, especially those linked to higher global energy prices. On the external front, the governor emphasized that the current reserve position is significantly stronger compared to the economic crisis period in 2022. This, he said, provides greater flexibility to manage disruptions in trade flows, fuel imports, and capital movements. He also reassured that the banking sector remains stable, with no immediate risks identified from recent global volatility. On fiscal developments, improved government performance and ongoing efforts to build buffers were noted as key factors supporting overall macroeconomic stability. However, the governor cautioned that the country's ability to withstand future shocks will depend on the duration and intensity of global uncertainties, as well as the strength of existing buffers. He added that while there is no immediate need to change the current policy stance, interest rates could be adjusted if the economic outlook shifts significantly. The Asian Development Bank has increased its financial allocation to Sri Lanka for 2026, while committing immediate support to address ongoing economic pressures. According to the President's office, the Asian Development Bank has raised this year's allocation from $380 million to $480 million, with $200 million to be released promptly in response to supply shocks linked to the Middle East crisis. The ADB president noted that he had observed the damage caused by the cyclone and reaffirmed the institution's readiness to support programs aimed at preventing similar disasters, including initiatives to protect water systems in the Central Highlands. Meanwhile, recent cabinet approval has been granted to secure $620 million from the ADB to support 5 key reform and recovery programs. These include $100 million for a trade, investment and industrial development program and $220 million to strengthen financial access for micro, small and medium-sized enterprises. An additional $100 million each has been allocated for water supply and sanitation rehabilitation, resilience and inclusive recovery programs and agricultural value chain financing initiatives. The ADB had earlier indicated its readiness to provide more than $1 billion annually to Sri Lanka from 2026 to 2029, reinforcing its long-term development partnership with the country. Sri Lanka's central bank governor has ruled out the need for immediate import controls or capital flow restrictions despite rising global uncertainty linked to the Middle East crisis. Central Bank of Sri Lanka governor expressed confidence that the country is better positioned to withstand external shocks, supported by improved macroeconomic buffers. He indicated that Sri Lanka is currently in a stronger position compared to the previous crisis and will continue to respond prudently as global conditions evolve. He added that the impact of the crisis is being felt across many economies, and Sri Lanka's position remains broadly comparable to others facing similar pressures. Recalling past challenges, Dr. Nandalal Veer-Singha noted that Sri Lanka has demonstrated resilience through multiple shocks, including the 2019 Easter Sunday attacks, the COVID-19 pandemic, the 2022 economic crisis, and Cyclone Detwa. He expressed confidence that the country can manage the current situation as well. The governor firmly rejected calls for immediate policy tightening, stating that there is no current requirement to restrict imports, capital flows, remittances, or outward payments. On external sector performance, he acknowledged a decline in tourism, with arrivals falling by around 17%. Despite strong visitor number earlier in the year, earnings declined by 4.9% year-on-year to $730.3 million. However, he highlighted that workers' remittances remain strong. Inflows increased by 33% year-on-year to $729 million in February, with total inflows for the first 2 months of 2026 exceeding $1.48 billion. He noted that there is no indication of a decline in remittances so far. He also stated that there are no signs of a large-scale return of Sri Lankan workers from the Middle East, nor any advisories prompting them to return. On monetary policy, Dr. Nandalal Veer-Singha explained that Sri Lanka continues to operate under a flexible exchange rate regime, where the currency is determined by market conditions. He added that intervention would only take place in the event of excessive volatility. The governor emphasized that authorities are closely monitoring developments and have already taken steps to manage energy demand, which could help contain inflationary pressures. He also stressed the importance of continuing structural reforms, including labor, land, banking, fiscal, and anti-corruption measures, regardless of external conditions. Sri Lanka's national inflation eased in February 2026, with prices rising by 1.6% over the 12-month period, down from 2.4% recorded in January. According to data based on National Consumer Price Index, prices on a monthly basis declined by 0.9% in February compared to a 0.4% increase in the previous month. Despite this slowdown, inflationary pressures are expected to build in the coming months. The report indicates that high fuel prices are already impacting both household and businesses' costs across the economy. Analysts note that the February inflation figure reflects past price movements and may not fully capture the recent surge in fuel costs. As a result, upcoming inflation readings, particularly for March and April, are likely to show a stronger increase. The rising transport costs have already pushed up the prices of essential and non-essential goods, suggesting a broader pass-through effect across the economy. The movement in global oil prices is expected to play a key role in shaping Sri Lanka's inflation path in the months ahead. Economists say higher fuel prices could reduce demand and ease inflation over time, while interest rates could help contain price pressures. However, both factors may slow down overall economic activity and growth. In the near term, the inflation outlook remains closely tied to global energy prices and domestic price adjustments. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.64%, up by 3 basis points. The 182-day T-bill rate stands at 7.95%, up by 4 basis points, and the 1-year T-bill rate stands at 8.32%, up by 9 basis points compared to the previous week. Thank you for watching. We'll be back next week.